So we know that the Fed is a tailwind here for the markets. That liquidity-driven market here is a theme that we've been talking about all year. But when you hear the words Fed and shrink, that can only mean bad news. Is this something that makes people rethink the Fed's commitment to not inflating the market, but supporting the market?
People shouldn't. The bill purchases that the Fed was doing really was in response to dislocations in the bill market, and certainly the Treasury is reducing bill supply. Just a lot of things were happening. They were always saying it was a matter of when, not if, they would stop the bill purchases, and we've seen that market become healthy again. So the market's wrong to interpret it that way. And I think Powell was very clear earlier this week when he was testifying that they are waiting for broadly, much better, broad, AKA I'm giving it a lot of time for the U.S. economy to really improve before they actually do anything.
Christine, how should we feel about things that are more interest rate sensitive? Banks, insurance companies. I know right before this we were talking a little bit about Andreas Halverson, a tiger cub, getting into AIG and MetLife out of all stocks in the fourth quarter of last year. I know you work for a big insurance company also. Is the Fed going to hurt these guys?
No, in fact, I would say, so taking a step back, what's priced into the market right now is one more Fed cut this year. And, Voya, we actually believe that it'll stay flat. So leaving that aside, we've certainly seen low interest rates. That does hurt business models like insurance companies. So, you have these products, you're expecting, treasuries plus corporate spreads to give you a certain return relative to what you pay out. And that's been a multi-year headwind. And I would say if you look at the multiples within the insurance sector, I think the market's gotten over-emotional about it. And so the thing, in addition to interest rate risk, there's always corporate credit events, right? These business models tend to buy credit as well. And do we see a default cycle? Do we see problems on the credit horizon that would impact that sector? No. So the combination of too emotional over rates from equity investors, as well as still a relatively benign, stable default cycle over the next 18 months, I think that the sector is certainly at a good valuation for entry.